we go ahead and get started. So thank you very much for joining. We're going to talk about self-managed super funds today. Talk about pros and cons, who they might be right for, and all things self-managed super funds. But first, anything you hear today is general advice. I certainly don't know anything about you, so I can't offer personal advice. And that doesn't mean you can't answer questions. So send through any questions in the chat or in the Q&A, or send them to me afterwards at mark.lamonica1@morningstar.com. Okay, so let's get started. So before diving into some of the specifics, it's important to talk about investing in general, because of course, your choice of where you keep your super is all about getting the best investment outcomes that you can. So what I've done is I've just outlined, and we'll go through some of these in detail, but I've outlined 5 steps, high-level steps to being a successful investor. And really what investing is about is either doing these steps yourself, getting support to do some of these steps in an effective way, and also making sure that you are minimizing costs and taxes that you pay. So sometimes investing is as easy as doing that. So we'll quickly go through them and talk about industry/retail super versus a self-managed super. So first thing that you probably heard me talking about a lot on these before, if you've attended, is setting a retirement goal and a plan to achieve it. So no super fund is going to do this for you. So of course, some may have tools involved, but it's really important to do this, to obviously figure out how much you want to have for retirement or need to have for retirement. And then the plan to do that at a high level is, of course, making sure that you are saving an appropriate amount of money. So we talked a little bit last week when we were talking about super, that there are options to increase your savings into super, whether that's a concessional or non-concessional contribution that you make, and obviously depending upon, based off your salary, what you're putting in with the 10.5% mandated amount. So no matter what you do, that's a really important thing that you do need to do by yourself. Next thing, obviously, based off of that plan, the return you need to achieve your retirement goals is setting your asset allocation. So asset allocation is really important, probably underappreciated, but there have been studies that have shown that about 90% of the variability of returns that different investors receive is based on asset allocation. Now, if you have a self-managed super fund where you're obviously doing this yourself, it is your responsibility to set your asset allocation. If you go the industry or retail super route, and this is where there are all sorts of different options, but what I'm really looking at here is some of the options that are available, either part of my super or just kind of the default, I guess that is the default option that you can go into, where there are these ready set portfolios already created for you. And a lot of those portfolios are around risk tolerance. So basically, when you start hearing words like balanced and aggressive, and you start reading the literature, it's really about how much risk you feel you can take on. So basically, how much variability in the year-to-year returns or even shorter-term returns of your super, and how much you can tolerate. So once again, we don't think risk tolerance is a great way to look at things. We prefer people focus on risk capacity, how much risk they have to take in order to achieve their goals. But either way, you do not have to set the asset allocations. You're generally following this guide that is set up on each one of those risk tolerances. The one thing I will put in here, it's not particularly about self-managed super funds, but the one thing I will put in there is that in many cases, what's a balanced fund with one super fund is just fairly different from what a balanced fund is also. So it does involve doing some work beyond just looking at that headline name of the portfolio you're investing in. It actually involves you looking at that asset allocation. And of course, as I said, with self-managed super funds, that is completely your responsibility. Picking investments. So picking investments is generally done within the confines of these portfolios, these multi-asset portfolios, and industry or retail super. Picking the actual investments is done by the super fund. So no responsibility for you there. Now, a lot of industry and retail super funds have expanded into more do-it-yourself investing options. One of the reasons is because they're trying to compete with self-managed super funds. And that can be everything from you going in there and setting the asset allocation percentages that you want within each asset class. And then they pick the investments all the way out to basically do it yourself super, where through that industry or retail fund, you're going out there and picking the investments. Now, this varies a lot. Certainly the costs vary a lot from different supers, both what those options are to pick investments, and then also, as I said, the cost to do that. But we're really looking at kind of the general sort of my super options here, just for simplicity's sake. Monitoring, maintaining your portfolio. So this is done by the super fund. So of course, if you have selected a balanced portfolio, they'll automatically rebalance that for you. So not a lot of maintaining that you need to do for a portfolio there. Really, it would only be decisions you would have to make if perhaps as you're getting closer to retirement, you want to move from a balanced option into something more conservative. Once again, that's completely your responsibility for self-managed super funds. And then, of course, we've got the transition to retirement and the pension phase. So that's when you transition from investing to starting to pull money out of your super to support your living expenses. Now, a lot of industry and retail super funds have varying degrees of options you can do when you're sort of balancing between your accumulation accounts and your pension accounts, if that's an option for you. I would say, and we'll talk about this theme more today, in general, there's limited flexibility from what you can do as opposed to a self-managed super fund where you have lots of flexibility about what assets you sell, about your asset allocation, certainly as you're kind of transitioning that into retirement. So one thing you'll probably notice in a theme today is, of course, a self-managed super fund, which you should pick up on the name. Self-managed involves a lot of investor responsibility. And ASIC came out with, and I actually don't know sort of their sources for this, but they came out with an estimate that it takes about 100 hours a year to manage your self-managed super fund. Now, some people are probably listening to that thinking that's way under what I spend. I like to research investments, spend a lot of time doing it. Maybe for some people, that's a lot less time than they spend. But just remember that all these responsibilities, of course, come with a cost in time. But let's get into the nuts and bolts with this. So remember, one important thing about any investment approach you take is minimizing costs. So we're going to spend some time focusing on cost. And it is a big consideration whether you decide to go into a self-managed super fund or not. It's not the only consideration. We'll get to some of the other things you should think about. But we're relying on, or I'm relying on today, a study that Rice Warner put out. So they actually did the study during 2020. They released it in 2021, and they're exploring the costs associated with self-managed super funds. Now, in every category of costs that we go through, they've got a high, medium, and low cost. And one thing to note is that all of these costs have been coming down over time. There's particularly a lot of new entrants on the market to support you with managing a self-managed super fund that would fall into this low category. But, I reversed these. Okay, so I'm an idiot. That is, of course, the high cost because it's more. But first thing you need to do is obviously you need to set up your super fund. There are really, your self-managed super fund, there are really 3 steps involved in this, as you can read. So there's the actual setup. There's a fee that you have to pay to ASIC. And then, of course, a service provider fee. So you can see the range of costs we have associated with this. So this is a one-time cost. And we'll focus more on the ongoing costs because those are really important. But there is a fee to actually do this for the first time, which is something important. Rodney pointed out that I screwed this up. So of course, yeah, that's high. It's supposed to be over there. That is low. But yeah, this is the one-time cost. But let's focus more on ongoing costs, because there is a big debate, and there has been a big debate in the industry around when it becomes, and when we say when, what level of assets are necessary for you to have a self-managed super fund actually be more cost effective for you. And kind of the history of this is ASIC originally set the number at around $500,000. So $500,000 worth of assets. And really this Rice Warner work and some lobbying by the Self-Managed Superfund Association got them to change that. And so in general, what people say now is you start to reach cost parity at around $200,000 worth of assets. But I want to explore this in detail. So we're going to go through and compare it to a couple different relatively low-cost providers on the market to see where we sit. So we're going to go through a couple different costs. Geez, I am a complete idiot. I did it again. Once again, that's high, that's low. So once again, besides my inability to label columns correctly, we want to look at some of these ongoing costs. So these are costs, of course, that you would pay every single year. So there are certainly fees that you have to pay that you can see, and all of these should be pretty self-explanatory. And really what we're talking about is in accumulation, what you would pay across the three different categories or three different levels of fees according to Rice Warner. And then when you move into pension phase, you do need a certificate. So it's basically an actuarial certificate that looks at what assets are in your pension versus your accumulation account, which in the self-managed super fund is really all pressed together, which is why you need that certificate. So there is there definitely is a cost associated when you go into that. So you can see those fees. The other big fee, and we'll spend a second on this, and this time I got high to low right. So there we go. I did something correct. The other big thing is, of course, investment fees. So I thought it was pretty interesting how Rice Warner did this. We'll talk about this in detail, but really what they're showing is a very low fee from 0.07% a year all the way up to 1.75% a year. And what you can see on different balance levels, how much this fee is. So let's talk a little bit about what this means. So this fee can be everything from the transaction costs. So of course, if you're in there trading with a broker, and they can also be the fee associated with any of the individual investments that you have in your super fund. So they didn't go through that much detail on how they delineated these three things, but just common sense tells us that if you are in a low fee category, that you are mostly investing in individual shares. So of course, with an individual share, once you go out and buy it, there is no fee going forward. So you're simply holding those shares. And the only cost that you would incur is, of course, transaction costs. So if you're falling in this low category, you are either primarily invested in individual shares, or you're primarily invested in or not primarily invested, or partially invested in very broad index ETFs or funds where the fees are very low. Anytime you get out of that kind of category around your investments, you're going to surpass this fee pretty easily at the end of the day. If you start getting into some of these factor ETFs that we talk about, or even not broad asset class ETFs, you're certainly paying a fee that's at least 0.3, 0.4 if you're in one of those funds or ETFs. The other really important thing is obviously minimizing trading costs. If you are churning your accounts and you are trading all the time, so likely you would pay more than that. And so that's where I think, once again, the flexibility that you get with the self-managed super fund is great, but it's being smart about how you are actually investing that money. So certainly in the case where you are making monthly contributions into this account, going out there and putting a little bit of it into a diversified portfolio obviously doesn't work very well if you want to keep those fee levels as low as this. The other side of these things, these high fees, to me, once again, are extremely high. I think it'd be very, very difficult for you to beat certainly an index or the returns you're getting from one of the better performing industry funds. For example, if you're paying 1.75% a year just in investment fees, obviously you have those other ongoing fees on top of it that we covered on the previous slide. Now, those fees are generally flat, meaning that whether your account has $50,000 in it or $1 million in it, you're still paying that same fee. But this 1.75% to me is remarkably high. But the place where you can get to these fee levels, and once again, this does have to do with the flexibility that's involved with a self-managed super fund, is all the different assets you can put into it. So, of course, we hear a lot about property. You can, of course, own a property in your self-managed super fund, but also all these other kind of strange asset classes that we hear about, whether that's art or wine or anything else that people want to invest in. So, like all investing, minimizing these fees is really important. It's really important. Just through this little example that I used. Wow, I am like horribly inconsistent of me screwing this thing up. Anyway, I guess low to high makes sense, but my labeling doesn't make sense. So all I did is I took the ASX 300 return over the last 10 years. So it's 8.14% per year. And then, of course, I subtracted these fee levels. And what you can see is $10,000 invested for 30 years. There are pretty dramatic differences in the amount of money you would have. So it's just a reminder and a demonstration, once again, that fees matter. And that if you're in this high fee category of 1.75%, it's just not a good place to be. And that's going to hurt anyone's investment outcomes, no matter what. So something to think about if I ever saw a super fund, a industry super fund, for example, that was charging 1.75% for an investment fee, I would never, ever even consider putting my money in there. So the good thing, once again, about self-managed super funds is the fact that you can have the flexibility to do what you want. Oh, that disappeared for a second. Have the flexibility to do what you want. The bad thing is sometimes investors do really stupid things with that flexibility. And fees are a big part of that. All right, so let's look at total cost. So I went in there and I looked at two different super funds. I looked at Vanguard's My Super option, kind of recent entrant into the market. And I looked at Aussie Super's balanced option. And went through and I looked at it. I didn't want to spend detail going through all the layers of fees in each one of them. So I just totaled them up. And I looked at the amount of fees that you were actually paying at different balance levels for each one of these products. So generally what you have here is you do have percentage fees as part of this. And those percentage fees, of course, vary based on asset levels. So what you can see here, and then I have, and this time I got it right. Then I have self-managed super fund, high, medium, and low. So what I've done here is I took those ongoing fees, forget about the setup fees. I took the fees that you pay every year, and then I tacked on those investment fee estimates that Rice Warner came up with. And so what you can see is where we start to get to points where a self-managed super fund has less fees. So you can see we cross that threshold at the $300,000 mark. And then for the rest of the low fee environments, we are there. Medium fees, you can see it's only on that higher category, but really what I put in here is, of course, that the fee had to be both Vanguard and Aussie Super. And this is a reminder that both Vanguard and Aussie Super are pretty cheap. So I wanted to have a high hurdle rate. So I looked at the cheaper end of the spectrum. There are a lot of retail and industry funds that charge much higher fees. So you would meet that threshold a lot quicker. And when we talk about cost, there's a couple other considerations that we need to make. And this is assuming that you are somebody who is in an industry or retail super fund and want to switch to a self-managed super fund. And the two things we need to talk about here when we make that switch are capital gains taxes and insurance costs. So let's start with capital gains taxes. So, of course, switching your super fund, selling out if you're in Vanguard or Aussie Super, selling out of all your investments there, moving your money into a self-managed super fund is going to incur a capital gains tax. Now, the interesting thing is we spend a lot of time focusing on at what balance level this makes sense. But remember, typically, obviously, higher balances come from people who are older and have invested more and have gotten bigger returns on their super. Those returns, of course, and those larger balances do mean from a dollar perspective, we're paying more with capital gains taxes. So the percentage is obviously the same no matter what. But from a dollar perspective, you're paying more as you get into a self-managed super fund. And I think the real consideration here is if you know you are going down that path, when would you actually do it? And even if you don't quite hit a threshold for a balance, there could be times where it might make sense to do that earlier, especially if the markets perform really badly. It's not a horrible time to switch super funds. Market's done really poorly. Some of those capital gains that are built into your super fund, of course, will be wiped out by those market drops. And then the hope would be, of course, that even if your balance doesn't meet one of these thresholds, once you move that money into your self-managed super fund, then, of course, you would be able to take advantage of those rebounds in the market, which would carry you above that threshold. So that's one thing to think about. The other thing to think about when we're thinking about what age we would want to do this, if it's something we're interested in, is insurance costs. Now, there's a couple different considerations here. Number one, remember that if you are in something like an industry fund or a retail fund, you are on a group insurance plan. Typically, group insurance plans, well, not typically, almost always, and that means the same thing. A group insurance plan is a lot less flexible than if you were to go out and buy your own insurance through your super fund. And what I mean around this is certain provisions that you may want to put into that insurance could be a problem. And one interesting part that I was talking to Shani about earlier, and she was mentioning, is particularly if you have income replacement in those insurance policies. So obviously, you get hurt, you can't do your job anymore. A lot of group insurance, once again, look at your own. A lot of group insurance says it doesn't really matter as long as you can work, you won't actually get to collect any of that money. Now, if you're a surgeon and you can no longer do that, but you can go work in a, minimum paid job, you're probably not going to collect anything, but that's something where you can actually write that into your policy. But the other consideration is life insurance. So once again, thinking about waiting longer to go into a self-managed super fund, a problem you can run into is all of a sudden your old insurance is gone. You need to purchase more life insurance and it costs more because you're older. And maybe there is more from health. Our health obviously tends to degrade over time. So maybe a couple things have gone wrong, a couple chronic illnesses or something else that, of course, makes that life insurance more expensive. So it's another consideration. So this isn't just a minimum hurdle rate that you need to get over in terms of a balance level. It also has to do with insurance. It also has to do with, of course, the taxes you're going to pay, which is a cost associated with moving your super fund into a different option like a self-managed super fund. So a couple comments, mostly from Rodney. He says, I don't know how anyone could have a 0.07 investment fee. Guess you'd only invest in IBD plus A200, for instance, and pray for no brokerage. Really what I see is you build a portfolio of individual shares. So there'll be transaction costs associated with going in those. But remember, brokerage can be very cheap and potentially free, depending upon the broker you use, Rodney. But if you pick individual shares, you will never pay a fee at the end of the day. So it's making your own portfolio. Now, you would think that there'd be higher transaction costs then as you go in and adjust your portfolio and continue to buy things. But yes, I think that's kind of the only thing that I see. And really minimizing your brokerage. But it seems very low to me as well. So David says, is last week's recording available? As I could not find it. We just have not put it up yet. So let me check with Will and see where we are on that. So thank you. All right. Let's talk about some of the benefits of a self-managed super fund. Now, on the next slide, I'll go through some of the pitfalls, which also can be benefits, but I want to specifically talk about the pension phase and some of the benefits. So the ones that immediately jump out to me personally, but we'll talk about some of the other ones. There are a fair number of advantages that I see from a self-managed super fund once you've moved into the pension phase. And number one is it is a little bit easier to handle everything. So in terms of, paperwork and everything else, you do need to fill things out, obviously, but you are not actually creating a new account. A lot of that sort of setup cost and everything else is the initial effort taken to create your self-managed super fund. But once you move into pension phase, other than getting that certificate, which kind of segregates those assets between accumulation and pension, other than doing that, there really is no work to quote unquote move assets. Whereas typically, if you're using an industry or a retail fund, it is setting up an actual new account. It is picking new investments. And there's a variety of different options. Once again, everything from sort of do it yourself to do some of it to just pick one of our ready-made portfolios. But there is some work involved moving into that pension phase. It's easier to do with a self-managed super fund. The other thing, and I put potentially there for a reason, is that there's more flexibility about the timing of your withdrawals from super within a given year. So obviously, once you reach that stage where you are taking money out of your super fund, there are, of course, based on your age, requirements from the ATO in terms of what you need to take out every year. But there is some flexibility around the timing of that within a year. And sometimes you don't have that option if you're an industry or retail fund. And you don't have that option basically because they're a big fund and they're very prescriptive about how the money comes out. So potentially it's every fortnight, potentially it's every month. But for some of them, there is of course that added issue around if you want to be flexible, take all of your money out the first day of the financial year, take all of your money out the last day of the financial year, and then flexibility around the timing across the year as well. And that can make things a little bit easier for you at the end of the day, depending upon how you are managing your budget. Couples. It's one of the benefits, of course, around a self-managed super fund, and we'll get to some downsides from this, is of course you can have more than one trustee involved in it. So it makes you able to, of course, get this with your spouse as an example. And there's a lot more flexibility around how you manage both of all of those assets sitting together than if you're going out there and you have different super funds, which have different rules around withdrawals, different rules around or different investment options available, and trying to sort of tie up, I'm in a balanced fund, my spouse is in a balanced fund, are they the same thing? How do I hold cash? There's all sorts of complications that come from kind of the structure and the rules around some of these funds. So there's a lot more flexibility in there, especially around withdrawals, right? So you can time those withdrawals together, which makes things easier. This last point is one that I get questions a lot around. There's a lot more flexibility for the most part, around asset allocation. Now, once again, a lot of these industry and retail funds are trying to compete with the rise and the popularity of self-managed super funds. So they are adding more options. But of course, you have complete flexibility with asset allocation and with the investments you pick in a self-managed super fund. So we talk a lot on these webinars about sequencing risk. And one of the methods that Morningstar is a real proponent of is, of course, this bucket method to asset allocation to try to deal with that sequencing risk. So very, very briefly, what it means is you don't typically want to sell investments when you are in a bear market from your retirement accounts. So you don't want to sell investments and withdraw money when you're in a bear market. You do want to give the market time to recover. And frankly, the only benefit of selling investments when they're at a loss is the fact that you don't have to pay taxes on it and get, most cases, a tax credit. None of that really matters, right, when you're in your pension phase, because you're not paying taxes. You're not paying taxes on what you take out. You're not paying taxes on capital gains. And so what that flexibility allows you to do is build up a cash cushion within your super fund and use that for those mandated withdrawals and the withdrawals that you need to pay for your life, rather than selling assets in a bear market. So there's a lot more flexibility there for you in a self-managed super fund versus if you are in something like Australia Super and you are in one of their established portfolios. Because when you say, I want to take $1,000 out of that account, well, they're not just going to take it out of your cash. They're going to go in there in most cases, and they're going to sell a little bit of everything. So maybe they're selling your equities in a really down market. So as I said in that first slide, one of the important things is to manage that pension period, your retirement period, and doing that effectively, which there is a lot more flexibility along with everything else in a self-managed super fund. All right. What are the pitfalls? Well, these are pitfalls, and also, as I said, they're benefits that are kind of looking beyond that retirement phase. So time and knowledge. So you need to know what you're doing if you're going to manage your self-managed super fund yourself, or you need to hire an advisor to do it for you, which of course is an increased cost over what I had on there. And you're going to have to spend time doing it. Now, time is an interesting one because there's probably diminishing benefits from the more time you spend on your portfolio. That, of course, does cause a lot of people to go out there and maybe overthink things and maybe do too much. So too much activity, too much trading, which can lead to bad things. But you do need to be interested and willing to invest time. And you have to develop the knowledge to manage those portfolios within a self-managed super fund. Now, some people find this incredibly liberating because, of course, they think there are a lot of benefits from the time they spend on this and the application of that knowledge they delivered. But just remember, this is a time commitment. And it's probably an education commitment where you need to continue to stay up to date with changes in market conditions. This flexibility I talked about around joint self-managed super funds can also have some downsides. One can be varying ages between trustees, which makes it a lot more difficult, of course, for you to manage. So this could be number one if you include trustees that you are not in a relationship with. I don't mean any relationship, but if you're certainly including people like your kids in the self-managed super fund who have very different retirement timelines than you do, that of course can be an issue. But also, even if it's your partner or spouse, where there are different retirement timeframes, right? So you're having to manage those, and certainly manage those around that investment strategy that you have, manage those differing ages around asset allocation, some issues there. The other one that, unfortunately I hear a lot about is that, typically in a relationship, it is one person Maybe typically is not the right word. Sometimes it is one person in a relationship that is interested in investing, wants to take on the burden, has the knowledge around investing to actually manage a self-managed super fund appropriately. And if that person passes away or somehow becomes incapacitated, that's a problem. It's a problem, of course, because somebody else is now stuck with the burden of managing a self-managed super fund when maybe they don't have the knowledge to do it. Maybe they don't have the interest or the time of actually doing it. So something to worry about. And then divorce. Divorce is a little bit of a problem with the self-managed super fund because actually unwinding a super fund. So obviously as assets get divided, if you have two industry funds with your spouse and maybe one party has more money in it than the other, well, you need to equalize those in your divorce. But at least that means you're only selling a portion of your super and facing those taxes if you're still working, facing those capital gains taxes on only a portion of your portfolio rather than the entire thing. So obviously, marriage is a big enough commitment. This is adding another one to it. If you get divorced as a self-managed super fund, you generally have to unwind the whole thing, which means selling all the investments before it gets divided between the two people. That can be a capital gains problem. So something to think about. Or maybe you can just stay together for the self-managed super. Maybe this more self-managed super funds would lower the divorce rate. The last thing is kind of this abundance of choice. And, a couple different things can happen here. Having lots of choices is certainly perceived as always being a good thing, but it can create problems. It can create problems, number one, because somebody tinkers too much with their portfolio because there's all these different options for them to go out and invest in. Investors create portfolios that are perhaps way too complex and costly when we looked at those costs, complex and costly for what they're actually trying to accomplish. So we see this all the time when we talk about active versus passive management and the fact that in general, active managers struggle to outperform passive. And these are, of course, professionals that are managing funds that have staffs and costs and everything else associated with them. They have a very difficult time doing that. And some of it maybe is just that they're getting too smart for their own good. Simplicity sometimes is not a bad thing, and people can actually make their portfolios too complex. The other thing, of course, is if you have a self-managed super fund with all these different options from investment property to art and wine and whatever else you want to invest in, you do start to attract people trying to sell you things. And all of a sudden you can find yourself, of course, getting in that situation where the costs of running your portfolio are a lot higher than what is justified by the performance and frankly, what's needed to achieve your retirement goals. So another consideration there. We have a couple more questions and comments. Yeah, and it's a really good point that Rodney makes around this flexibility is that, yes, some people, of course, not even making things too complex. Maybe they make things, I don't know, too simple is the right word. But because of the popularity of property investing, because of the fact that you can do it within a self-managed super fund, people can allocate most or all, as Rodney pointed out in the Q&A, of their assets into something like a property. And that can cause you a lot of problems. It can certainly cause you problems as you move into the pension phase and you need to start taking money out of your self-managed super fund. There's certainly a lack of liquidity if you own one investment property. It can certainly cause problems if something goes wrong with that property, whether that's issues with the tenant, whether that's issues in a particular location that makes prices fall or prices do not rise as much as you need just because of that specific location and lack of diversification. But yeah, it's a really good consideration at all. So, it basically gives you, at the end of the day, self-managed super fund gives you the flexibility to go out there and make very specific and smart decisions that are targeted towards what you're trying to accomplish. And it also gives you the flexibility to make very dumb decisions that don't serve your needs as an investor at all. So that's a really good point, Rodney. So yeah, like anything, you're going to do it yourself. You should know what you're doing. So Phil says, my Aussie Super fees were only about $500 last year. Did your fee calculations include insurance? It did not. So basically, I looked at a couple of different things in there, Phil. And Vanguard is actually super easy because they've got like a calculator in there. So what you're basically paying with Aussie Super is you pay a admin fee. So I think it's $1 a week. And then you've got a percentage based admin fee that goes up to a maximum amount. I don't remember what it is. You have the investment management fee. So basically what you are paying for, and I was looking at the balanced portfolio option, what you're paying for the investment management services there, and then there's transaction fees as well. So those are the ones that I looked at, Phil. So not sure why you're paying $500. Maybe you have a special deal. Okay, and Phil's making another observation. I said that these do vary based off of the super funds. He says he has cash and fixed interest buckets in his Aussie Super Fund, and he confirmed that he can direct the fund to draw down from those to avoid sequencing risk. Yeah, so I think that's one of the cases where a lot of these, as I said, a lot of these sort of industry and retail funds have added a lot more flexibility. So you can do some of these things now, and certainly, the Aussie Super I know, which I use. There is, I don't use this, but there is a do-it-yourself option where basically you go out there and trade what you want and go out there and buy what you want. So yeah, I guess my observation is at the end of the day, what we're seeing and what we've seen over the years is we've seen the fees for managing self-managed super funds come down. And then we've seen the services provided by a lot of industry and retail funds expand because at the end of the day, they're just competing for the same people, all of us that have super. So that's a good observation. Yes, Manny, I am sorry. I have problems with labeling columns. So I will update that and work on that for the next one. So at the end of the day, that's really what I wanted to cover. But what I would say is, anytime we're thinking about investing and anytime we're thinking about investment products, investment structures, really we want to start with us and what we're trying to accomplish. So all of us have different personal circumstances. All of us have different goals at the end of the day. And I see a lot of arguments in the industry, and I wouldn't call them violent arguments, but certainly among investors saying this is right or this is right. But really, there's only what's right for you. So if you are considering moving into a self-managed super fund, I go through a couple of those things I talked about. Look at costs. Look at the costs, not just the ongoing costs, but actually the cost of moving into a self-managed super fund. So that is capital gains taxes that you're going to pay, potentially costs around insurance, and there's flexibility issues in there as well. And then, of course, there's setup costs. So the setup costs, at the end of the day, we can simply take those setup costs, distribute them over the number of years that we think we're going to be alive, and see what that annual cost is. But yeah, lots of considerations. So not that it matters what I do, but probably tell by my accent, I have not been in Australia my whole career. I still use Aussie Super, which I'm pretty happy with. I would expect at some point, and maybe sometime somewhat soon, to switch into a self-managed super fund. But yeah, just haven't really figured out the timing yet. So Phil says the ongoing government tinkering with superannuation could involve self-managed super funds as well as the future. Yeah. one thing that even I find frustrating, I'm a big fan of super, really moving from the US where very few people actually save for retirement. I moved here and always thought they were great things. But, what's frustrating, I think, for everyone is the fact that really what you want around taxes and around rules around super is consistency. And I certainly agree with a lot of people that find it very unfair that they have put money into something and forced, in a certain extent, to put money into something that continually changes. So it's a really good point, Phil, that yes, that is a problem as well. So Rodney says, do any of these ongoing fees you estimate cover accounting costs, assuming you use an external candidate? I believe they do, but let me go back and double check that Rice Warner survey. So I can do that and reach out to you with Rodney with those results. So Alex says, I think the dollar amount switch looks obvious, but does age matter? So I think age matters. I think age matters potentially around things like insurance. I'm trying to think of other reasons why age would matter, but probably not. At the end of the day, those setup costs, if you were older, of course, you have less of time that you're going to be in that self-managed super fund. You distribute those setup costs against less years if you're really trying to account for them. But yeah, I wouldn't see those as being probably that big of a deal at the end of the day. And just my opinion, the fees aren't outrageous to set up a super fund. So yeah, I can't see why age would necessarily matter. Anyone else has an opinion, let me know on that. But yeah, I couldn't see a reason why age would actually matter. The only thing that I would say kind of about age is that as you get older, if you've been investing for your entire life, potentially your capital gains taxes are higher. And that's really when you want to think about that timing and when you want to do it. And it's at the end of the day, obviously a lot of capital gains taxes, once you move into your self-managed super fund, are up to you. So it matters how many transactions you have. It certainly matters if you're in there kind of churning your account, generating constant capital gains. You have more control over that. But yeah, that's the only thing I can think of, that, not waiting too long until you're paying these huge capital gains taxes. And obviously the tax that you're paying is better in super than it would be without, but you're still paying it. Which is something that would be a consideration. So Rodney says, the reason I ask is my annual accounting fee for family trusts, presumably simpler than a self-managed super fund with all the regulations, requirement, paperwork, et cetera, are higher than your total high entry. Interesting. Yeah, let me go back and look at that for you, Rodney. Maybe you just have a really good accountant. But let me go back and look at exactly what goes into those fees. I do believe they're all inclusive and they include accounting, but let me double check on that. All right. Well, anyway, thank you guys very much for joining. Any kind of questions or comments, you can feel free to send them through to my email. And if anyone happens to be going to the Australian Shareholders Association conference in Sydney this week, Thursday and Friday, I'll be there. I'm talking on Thursday if anyone's interested. But anyway, thank you guys very much.
This video has been prepared for clients of Morningstar Australasia Proprietary Limited and or New Zealand wholesale clients of Morningstar Research Limited. Any general advice has been provided without reference to your financial objectives, situation or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest. To obtain advice for your own situation, contact a financial advisor.